Good evening, everyone. Great to see you guys this evening. I'm Hazel from the Joyful Investors. If any one of you can't hear me clearly, please do let me know in the chat box, all right? So for those of you who are joining us for the first time tonight, this is our monthly Zoom webinar to share about what has been happening in the stock markets recently, as well as sharing about our insights on the stock markets, right? So usually such sessions, I would like to keep it short and sweet for you guys, right? So within 45 minutes to a maximum of an hour for such monthly Zoom sharing sessions. So I'll just do a very quick roundup of the markets and to share some of the things that I would like to share with you guys. So if you're able to join us on time for future sessions, right, please do join us on time so that you won't miss out on any part of the sharing, because this is going to be a very quick and short one. Right, so if any one of you can't hear me clearly, please do let me know in the chat box right now, all right? Okay, so before I begin, just a very quick disclaimer over here. Whatever I'm going to share with you guys tonight, it is not financial advice, nor is it a financial recommendation, right? So all this sharing is for educational purposes. So before you make any investment decisions, please do your own due diligence. Okay, so this is the agenda for tonight. The agenda for tonight's sharing will be as follows. I will start off with the sharing about the China markets first, right? During the previous webinars, there were requests from some of you guys to talk about China markets as well. So tonight's sharing, I'll cover on that as well. Usually I start off with US market first, so I thought perhaps tonight I can just do a slight change. And I'll start off with China markets first before I move on to the US stock markets. And for the US stock markets, I will share with you guys one valuable lesson that we can take away from this recent US stock market crash and the recovery, right? And for those of you who missed out on the rally right now, what can you do next? And before I end off, I'll also do a very quick update on the Singapore REITs as well. Okay, so with that, let's begin. On China, so for China, as expected, the reopening of China's economies after pivoting away from the zero COVID policy, it is met with a lot of speculations and a lot of mixed sentiments. Now, if you just do a quick search on the internet, this is what you can actually see. You can see that half of the content, they are talking about how the bulls are not convinced about the recovery, while the other half, you can see, talking about their positive sentiment for China equities rebound, right? So you have some of the headlines that says market not convinced about China's recovery. On the other side, you also have China's stock market very underestimated. China's stocks wipe out 2023 gains. Okay, Morgan Stanley, China's overall journey to recovery is on track. Okay, so we have very mixed sentiments, very mixed view on the performance of China's stock market and the China stocks. Now, if you take a look at the recent economic data for China for the month of May, it actually showed that the economic activity across the major sectors have slowed down. If you take a look over here, industrial production, it has fallen, right? Retail sales as well. In fact, for the other areas as well, for the other major sectors as well. So what we can see is that retail sales, industrial production, they meet their expectations, and in fact, this momentum of the economic recovery in China is slower than what many of the economists expected, right? Now, but what is positive about China is that the Chinese policymakers, they have pledged their willingness to support the economy on multiple occasions. In fact, they said this many times, not just on one occasion. And this is not without any action at all. The most recent move that we saw in China is that the central bank has cut the medium-term lending facility rate from 2.75% to 2.65%. And prior to that, the China's central bank has also lowered the 7-day reverse repo rate, which is the short-term rate, from 2% to 1.9% for the first time in 10 years. So this will then help to reduce the borrowing cost, to stimulate consumption and to stimulate growth, right? And it is expected that additional easing measures and additional stimulus will come in the coming months to counteract the weakness in China's economy right now. Now, so what does all this mean, right? With weak data and then with the policymakers coming in and saying that they are going to support the economy. Now, so what does all this actually mean? Now, I leave it up to you to decide, but it does seem that they are committed to act on it to spur the economy. No doubt there may be some short-term pain ahead, but we have to also be careful not to mix up the short-term structural issues that they are clearing up with the longer-term opportunities that we may have. And more importantly, as I always share with you guys, the focus should be on whether the individual businesses in China are still doing well, which will then determine if we want to be investing in these businesses, right? If we want to be investing in these stocks. And if they are able to still perform reasonably well, despite the current economic headwinds, then that will be even better, right? So we don't buy a stock just because China's economy is doing well. That's not how it goes, right? The business itself has to be doing well before you are willing to invest in it. Because the asset that you're owning is the business, right? So the business itself has to be doing well. So let's take a look at one of the businesses in China, okay? Which for tonight, we'll talk about Tencent, right? Now, all of you know that Tencent is actually one of the affected companies during the crackdown in China 2 years ago. So what happened was that back in 2021, the Chinese government actually set a limit on the amount of time that the young online gamers can play online video games. And not just that, they also temporarily stopped the release of the gaming licenses until somewhere about mid-2022, when the freeze on the gaming licenses was actually lifted. So how has Tencent performed for its financials so far since the crackdown? So let's take a look at it. So first, this is what you have to understand first. You need to understand how does Tencent make its revenue. So Tencent makes its revenue through the following segments. The first one is their value-added services, VAS. What does it refer to? It comprises of the domestic gaming, the international gaming, as well as their social networks, right? Their WeChat, Weixin, QQ, right? So VAS is also their largest revenue segment. It makes up about 50% of Tencent's total revenue, all right? Then coming in next, the second largest revenue segment is the fintech and business services. So this comprises of the mobile payment, the wealth management, and cloud, and so on. And it makes up about 30% of Tencent's total revenue, right? Coming in after this is online advertising, which makes up about 15% of Tencent's total revenue, okay? So there you have it. The largest segment is actually VAS, followed by fintech, and then online advertising. Okay, so let's take a look at how they have performed in the most recent earnings report. So the most recent earnings report for Q1 of 2023, overall, the revenue has actually increased by 11% year on year. Okay, you can see over here, revenue has increased by 11% year on year compared to Q1 of 2022. Both the operating profits and the net profits increased by 10% year on year on an IFRS basis. Now, some of you may think, hey, it's just a 10% jump in revenue and profits, right? Doesn't seem that enticing for tech stock. Now, but bear in mind, all this actually happened. The current growth happened against the backdrop of the recovery from the tech crackdown. It also happened against the backdrop of the slowing economic growth in China from COVID. So this performance, I would say, is actually not too bad, right? It's actually not too bad because considering what have happened right now and all the headwinds that they are facing. Okay, now if you take a closer look at the financial performance, we can see that this is the revenue revenue by segment, you can see over here. In fact, if you compare the total revenue for 2022, the year before, compared to 2021, it actually fell, okay? For 2022, if we add up all the 2022, right, it actually declined as compared to 2021. So right now, revenue growth is now picking up with the revenue in Q1 of 2023 exceeding Q4 of 2021 really. So the revenue growth is now picking up already. So they actually had a bad year for 2022, but right now it seems that the growth is starting to pick up for Tencent. Right, and to top it up, what is also very positive to see is that all the revenue segments over here, you can see that they have posted revenue growth. Okay, so we have the VAS, so there is a growth. In fact, social networks, domestic games, international games all had a growth. And then online advertising as well, fintech as well, right? So all of them actually posted growth. So growth is not just coming from one single segment, but in fact, all the revenue segments are recovering pretty well. So for example, if you take a look at gaming, right? Tencent is known for the gaming part. The domestic gaming is up by 6%, while the international gaming is up by 25%. Right. And with the current changing stance of the Chinese regulators, where they are right now more focused on fueling stable economic growth, that can also pave the way for more pipeline releases for their gaming as well. Okay. And if you look at another example, fintech services. Fintech services also recorded a double-digit year-on-year growth. Okay. And this growth actually is mainly driven by the recovery in the payment services that comes from the consumption rebound in China. Now, right now, as we have seen from the earlier slides, the economic data for China is still not as strong. So when the consumption recovers further in the future, that can translate to even more growth for the fintech services in time to come. Right, and all this is also before the implementation of artificial intelligence (AI), which Tencent has yet to unveil, and that part still remains as an unknown as to how it may further drive further growth for Tencent's existing ecosystem. But as we all know, Tencent being the dominant player in the gaming as well as in the social network, that may help Tencent to actually tap on the huge amount of data to train its AI. Right, but in terms of how much growth that can actually generate, that is still unknown. Okay, but that is a potential growth driver in time to come, right, in the future. So overall, for Tencent, this is what we see, right? In fact, it is maintaining its dominant position in almost every of the market that is competing in, right? Number one in almost most of the market that is competing in, whether it's gaming, digital payment, or social network. And that's what we want to see when we are investing in companies. Right, what we want to see is whether a business has some competitive edge over its competitors to lead the market and maintain its dominant position. All right. So with that, now the next question that you guys probably have is, so since, right, Tencent's financials seems to be doing pretty well, then when will this share price actually recover? How come the fundamentals are not reflected in the share price? Right, you see over here, this was the huge crash, right, for Tencent. And right now, this is where we are. Okay, how come we are still not back to the all-time high last time? Now, you see, in the short term, the share prices, they are driven largely by the sentiments, right? They are driven largely by sentiments, which may not be a true reflection of the real value of the business. And this is especially prominent in China stocks. Why? In the Chinese market, you can see larger fluctuations in the stock prices, even in just a single trading day. And that can be driven by just a single event that happened, right? So such huge fluctuations for share prices is especially prominent in the China stock market, right? So in the short term, the share prices are driven largely by the sentiment. But over the longer term, the share price would usually move in tandem with the fundamentals. So we got to give it more time for the recovery. When exactly will it go back to all-time high? no one can tell, right? I can't give you an answer for that as well. And in fact, when it comes to recovery after a crash, it does not necessarily has to go up immediately like this. That means it doesn't have to be a sharp V recovery. Now, there are occasions where instead of this, let me change the color. Instead of this, it's possible that the share price can do some consolidation before they move up. So that is also possible. Okay, so how would this recovery take place, in what form, right? We are not able to predict that. So we got to give it more time for the recovery, right? Okay, so this is what I would like to share with you guys for China. Okay, so next is the US stock markets. Okay, so what do we have for the US stock markets? All right, so for the US stock markets, the S&P 500 has already rallied up by more than 20% from the bottom that was made in October 2022, last year. So the commonly accepted definition is that a new bull market begins when the stock prices rises 20% above the bottom of the crash, right? So this is the commonly accepted definition. So what it means is that, we are officially in a bull market right now for the S&P 500 based on this commonly accepted definition. So this rally that we saw happened against the backdrop of the most severe rate hikes that we had in decades, the turmoil that's faced by the regional banks in the US, as well as the ongoing recession fears, right? We are still talking about whether there is going to be a recession that's coming, right? So this list of worries, as you saw, it never ends, right? The list of worry never ends. But what we saw in the stock market is that the stock market continues to push up higher. Okay, despite a long list of worry, what we saw is that the stock market continues to push up higher. So we have this more than 20% rally from the bottom that was made back in October 2022. So this is the S&P 500 index stock chart. Right, so many investors, they always have this mentality, right, that to be a good investor, they have to read up a lot on the economy, that they must be able to develop a macro outlook, and they must be able to invest based on what the macros dictate. Now, but as we have seen in what just happened for this recovery, despite this long list of economic worries, S&P 500 continues to rally up higher. So if there is one valuable lesson that we can take away from this stock market crash and this rally, it will be this. Now, to be a profitable investor over the long term, it is to invest based on whether the business can still generate more profit, whether the business is still generating more profits, whether the business is still generating more organic cash flow, right? And whether the business is still able to maintain its competitive advantage, whether their profit-making ability is still intact. To be a profitable investor, the focus is less on the macros, like how will the rate hikes be? Will the Fed continue to raise the hikes in the rest of the year, right? Or whether a recession will come this year, or will it come next year, right? Or whether the inflation will ease, will it shoot back up again, right? Yes, sometimes the macros may impact the short-term earnings, right? The near-term earnings of businesses, and also their short-term stock prices. Now, but these are in fact not risk events. These are not crises. These are in fact opportunities for us to grab more shares of the good businesses that we want to own. So that over the longer term, as the share price recover, we will be able to move in tandem with the share price. We'll ride the wave up, and that's how you can harvest your gains, right? Because over the longer term, the share prices will move in tandem with the fundamentals. Even when there is still widespread pessimism about the macro outlook, even when people are still, the economies are still thinking that we need more time before we have an economic recovery, the stock market can still recover, right? Because the stock market moves ahead of the economy. Okay, so we act according and we move with the stock charts, right? With the stock price movement, not with the macro outlook. Now, in fact, this is also the same way which Warren Buffett one of the greatest investors in the world, invest. He shared in multiple occasions, not just one occasion, right? He shared in multiple occasions that he don't pay attention to what the economy say. Now, let's take a look at what he said. During back then in 2016 interview with the CNBC, this is what he said. He said, I don't pay any attention to what the economy said. You have all these economies with 160 IQs that spend their life studying it, but can you name me one super wealthy economist that ever made money out of securities? No. And in 2019, interview with Yahoo Finance, once again he said he don't use any of what the economy said as a guideline for his investments, right? And in 2023, just recently this year, all right, again, he said, I've been in the business running Berkshire for 58 years and have never opined at economic forecast of any use to the company. If I depended on the economic forecast, I don't think we will make any money, right? So even Warren Buffett, one of the greatest investors in the world, said this, right? He don't invest based on the macros. He don't listen to what the economy said because those are not what are important to help you make money in the stock market. Now, over the years, one of the biggest reasons why many investors miss out on the bull runs is because the macro pictures are just looking impossible for the stock market to recover and rally up, right? You're hearing all the pessimistic news. But at the same time, what happens is that the stock market continues to rally up, right? Just like what we are seeing right now, right? At the same time, you also see lots of content online that predicts a bigger crash, right? You will hear the news media, you will hear the financial influencers talking about how a bigger crash is coming based on the macro study. We have also shared on our public Telegram channel, right? That while it is great to understand how the economy works, it is even more important as an investor to learn how the stock market works so that it can be profitable. Because remember, at the end of the day, our goal is to be a profitable investor. Our goal is not to be an economist, all right? It's to be a profitable investor. So to be a profitable investor, we need to execute two actions, right? There are two actions that you need to do. The first one is you must be able to identify good businesses. So this is the first one. You must be able to identify good businesses to invest in. And how you do that? You do that by analyzing the financials. Because over the long run, the strong fundamentals will be reflected on the stock price rally. Now, once you're able to do that, then the second action is to buy them at reasonably good prices by analyzing the stock chart to do so. Now, as we have seen in the past 2 years, the stock market moves in the direction that it wants to. So there is no point in fighting against the stock market, right? So what should we do? When the stock market does a pullback, it is the time to buy at great discount. When the stock market does a rebound, it is the time to ride the wave up with the stock markets to enjoy the gains and to even harvest some of your gains, okay? And some of the gains that you harvest, you can actually put it back into the stock market, plow it back into the stock market on other stocks that are having good opportunities at that moment in time. So these are the two things that you need to do to execute to be a profitable investor. Now, let me show you some examples. Back in November 2022, last year, during the Zoom webinar, I spoke about Adobe. So those of you who were present in the webinar, I'm not sure if you guys can still remember. So what I talked about was that there was this disconnect between the earnings and the share price. So what is this disconnect about? Now, we saw is that the share price of Adobe was actually lower than the pre-COVID times, when in fact the earnings are doing better than the pre-COVID times, right? You see over here, the EPS is actually doing better than the pre-COVID times, but what happens? We had a huge market crash. We had a huge crash such that the share price back then was even lower than pre-COVID times. So there was this disconnect between the earnings and the share price. Now, but was this an opportunity or was it a crisis? Was this an opportunity or a crisis? Well, it depends on how you see it, right? How I view it is that I saw that as an opportunity. In fact, a wonderful opportunity to buy more shares at the lower price. Because the fundamentals of Adobe was still intact, right? Nothing has changed despite a 40%, 50% pullback for the share price. Adobe was still growing its profits, still growing its cash flow. It was still maintaining its position as the market leader, right? So now that it is selling at a lower price, that is actually a good opportunity for us to buy, okay? And since then, what we saw in the stock market is that Adobe prices have actually gone up by more than 40%, right? Since November 2022, right? Since the sharing, Adobe share price has really gone up by more than 40%. Now, of course, I wouldn't have been able to predict how long it would take for this recovery, right? But with the mindset of a long-term investor, I was prepared to hold on to Adobe shares, even if it takes longer than this for the recovery, right? Because what we know is that this is temporary. Eventually, at some point in time, the share price will recover and will continue back on its long-term uptrend. And I will be duly rewarded. So that's the kind of mindset, that's the kind of thought process that we go through when investing in the stock markets, right? To decide what to buy, when to buy, all right? And for those of you who have been following on Adobe, you also know that Adobe has actually recently released its earnings for Q2 of 2023. And the results demonstrate that there is still a strong demand for its diverse portfolio of products, all right, from both individuals and enterprises, despite the current poor economic outlook. So how has Adobe performed? I just do a very quick update. Total revenue has increased by 10% year on year. The digital media and digital revenue grew between 10% to 12% year on year. So this really makes up about 98% of their total revenue. Okay. And their earnings per share also grew by 13% year on year. Right. On the other hand, for investors who saw this declining share price and who saw this market crash as a crisis, as a risk event, they would not have taken any action over the past 1 year. And they will have missed out on the gains when the recovery sets in. So which camp of investors do you want to be in? Now, I leave it up to you to decide, all right? Do you want to be in the camp that, see this as an opportunity, or do you see this as a crisis and a risk event, right? And it's not just S&P 500 that saw the recovery, not just a few of the stocks. In fact, if you look at NASDAQ or many of the tech stocks, right, you will have seen that many of them have already started on this recovery from the bottom since October 2022, right? So for NASDAQ, let's just use the QQQ ETF as reference. Now, if you look at QQQ ETF, it has really rallied up by more than 40% since the lows back in October 2022, right? And what we saw is the very prominent uptrend, right? If you can see that prominent uptrend, higher highs and higher lows, right? Which indicate an uptrend. Now, before you guys get me wrong, I'm not trying to encourage any of you to go on a shopping spree in the stock market right now, okay? In fact, at the current price levels for some of the stocks, for some of these indices, I personally would not be keen to initiate another new position right now, to buy them right now. Because the time to buy for some of the stocks, some of the indices, it have already passed. Now, but having said that, there are still others that you can still pay attention to. Now, let me show you some stocks and indices examples. Okay, so let's start off with QQQ ETF first. So QQQ ETF as a first example. This is one example where I wouldn't be interested to actually be buying at the current moment because the prices have already got run up by a lot, right? And currently the price is actually overextended. While high can actually go higher, I always prefer to make more value purchases. So when would I be more interested to buy? When I see a retracement back down, right? I only buy when there's a retracement, after the price goes through a retracement. Although high can go up higher, but I always like to make more value purchases. Why? Because in that way, the risk to reward is more favorable for me. All right, the risk to reward is more favorable for me. Because what you see in the stock market is that prices don't go up in one straight line like this. Instead, even when they recover on an uptrend, they will move up, come down, move up, come down, move up, come down. So I would prefer to buy when during the retracement portion, right? So that the risk to reward is more favorable for me. Similarly, if you take a look at S&P 500, using the SPY ETF as an example, I would also not be interested to buy right now. I'll only be interested to buy after it goes through a retracement. Just like how we saw the recovery from the bottom of the crash, it didn't happen in just a straight line directly. It went through short rallies and pullbacks, all right? Let me draw it out for you. It went through short rallies and pullbacks. So you can see, after it rallies, it pulls back. After it rallies, it pulls back and rally again. So I will only be more interested to buy when it does a pullback again. So this is because in terms of the risk to reward, it is more favorable for me. So ideally, I'll only be more keen to buy when the ETF price does a pullback after the current rally. Now, one more example over here, Apple. Now, Apple is another example where I would not be keen to buy at the current price level. Okay, yes, Apple stock is a fundamentally good one, right? So it passes the first criteria where I want to buy a good business, but it doesn't pass my second criteria because right now at the current price level, the risk to reward is not in my favor. So I will only be interested to buy Apple if it goes through a retracement. In fact, the time to buy Apple, right, should have been months back during the crash, right? But the thing is, many people don't dare to buy. So let me share with you one example. One example of a good price level to buy Apple would have been when it was testing this horizontal support over here. When it was testing this horizontal support over here, those were actually good price level to buy, because in terms of the risk to reward setup, you're actually buying at a very good price level. And right now, that's actually not really a very good setup for us to buy in terms of the risk to reward, right? And that using horizontal support, right, it's only just one analysis. If you're able to apply more in-depth technical analysis, you will be able to identify more price level to buy in at stages and lower down your average cost. So instead of just always harping on Apple, I would rather go and look at other stocks, which are also quality stocks, but they are still beaten down and they are still at better price levels right now based on the stock chart analysis. Because always remember, Apple is not the only good stock in the stock market. There are many other stocks as well, right? For example, if you guys could still recall, last month, and in fact, last year as well, I shared about Procter & Gamble, right? And I even draw out the support levels for Procter & Gamble. And those support levels are actually good price levels to buy at based on the stock chart. So one example was 136. If you look at this price level 136, in fact, this year around February and March, this support level was actually tested. And after testing this support level, what happens? The price actually rebound back up. And more recently, in May this year, the next higher support level at $144 was tested again. And prices, after testing, it shoot back up again. So this were actually much better price levels to accumulate the positions of Procter & Gamble at reasonably good price levels. Because these are better risk to reward entry points that I would personally be more keen to take up instead of always just chasing after the stocks that have already run up, chasing after the stocks that have already hit their all-time high and hitting new all-time highs. Instead, I would prefer to look at other stocks that are also good stocks, but buy them at better risk to reward setups, right? So this is an example using support, horizontal support level. That is one example of how we can do so. Because recall, what is horizontal support? Support is the region where there's enough buying pressure to push the price up. So when you buy at a support level, in terms of probability, there is a higher probability that you have a price rebound and you are buying at the lows near in the short term. So this is how we actually make use of the support level to help us to identify better and more reasonable price levels to buy at. So that way our risk to reward will be better. So we are buying a good stock and we are buying it at a reasonably good price. So that is what we want to do. Another one, Domino's Pizza. I shared about Domino's Pizza back in April this year, right? So it's just 2 months ago. And right now, if you go to Domino's Pizza stock chart, the share price is still very much beaten down, right? So if you miss out my sharing back then, you can still check back the replay video on our website at thejoyfulinvestors.com, right? So although quite a number of stocks, especially tech stocks, have already rallied up by a lot in the recent recovery, but it's actually still possible to find other stock ideas which are also quality stocks, and they are still selling at attractive prices. So that way, by doing so, it allows me to be placing my money on stocks that are not just good only, but they also have favorable risk to reward based on the price that I bought. So they are not just good, but I'm also buying at a good price. So by doing this way, I can utilize my capital more effectively. And all these are actually risk management techniques to lower my overall portfolio risk over the long term. Now, one common question that I get from some investors when I share about all this is that some of them will ask me this question, but what if I have nothing to buy after I look at the stock charts and I end up leaving my cash idle for too long? Then isn't that bad? Now, I can tell you most of the time, the problem that I face is not having enough capital to buy the stocks that are selling at good price level. The problem that I face is usually not that I have nothing to buy, but that I have not enough capital to buy. Why is that so? Now, the reason is because you have to understand that the stock prices for various stocks, they go through pullbacks, they go through recovery at different periods in time. And their recovery take place at a different pace as well. Now, even during a stock market crash, like the one we saw in 2022, many of the sectors experienced that crash. But we also saw that during the recovery, different stocks, different sectors, they recover at different pace. Even within a similar categories of stocks, let's say tech stocks, you can see that some are recovering faster, like Apple, while some are actually taking longer time to recover back to their previous highs. So this is why there are actually a lot of opportunities along the way for us to find stocks to add into our portfolio. So I find that the concern is not about having no stocks to buy, leaving your cash idle. Now, in fact, the concern that I have is I don't have enough capital to deploy when I want to buy something. It's just like how we do our shopping in our everyday lives, right? You see, there's practically a sale going on every month. You have 10-10 sales, you have 11-11 sales, 12-12. Actually, these days, every month they do it, right? Even 5th May, 6th June, 7th July, all these, they can also come out with a sales and promotion. So the bigger problem that we always face is not that we have nothing to buy, right? But I don't have so much money that I am always shopping in every single sales. Okay, so that is likewise the same problem, I would say not really a problem, but the same problem that we face in the stock market, right? It's not that you have nothing to buy, but more so that you don't have enough funds to buy. So when investors ask me this question, what if I have nothing to buy? What if my cash is left idle? This is what I always tell them, right? The bigger worry is not enough money to buy, not that you have nothing to buy. Okay? Most of the time, there is something for you to actually buy in the stock markets. Okay, so that's for the US stock markets. And lastly, for Singapore market, just a very, very quick one for Singapore REITs. What we saw for Singapore REITs is that the performance for the first half of the year, because we are now in end June already, the first half of the year, the REIT index, S-REIT index is actually down by 2%, about that, right? At one point, we were actually up by nearly 10%, but all the gains were wiped out in the second quarter of the year. Now, but ask yourself this question, has things really changed that much within the last 6 months that is insufficient to garner this 10% rally and then the wipe off of the 10% gains? Has things really changed that much that I saw such that we have a 10% rally and then suddenly the 10% is wiped out? Right? Not really, right? The businesses of the Singapore REITs didn't really change that much in the first half of the year, right? Not really. So as you can see from so many examples, not just US markets, China markets, Singapore markets as well. In the short term, the share prices are often influenced by the sentiments, and it's not necessarily because of the fundamentals of the businesses. So some of these REITs, some of these stronger Singapore REITs, they continue to show stable performance, stable financial results. and resilient balance sheet. That's what we saw during some of their earnings reports. And in fact, the stronger ones are able to maintain their gearing ratio at a level where there is actually adequate headroom from the required regulatory level of 50%. So they still have some headroom from this 50%. Right. For those of you who are not familiar with gearing ratio, okay, it is a ratio that is used to monitor the leverage, the financial leverage of REITs, whether or not they're taking on too much borrowings. So what happens is the MAS sets a regulatory limit of 50% for the gearing ratio. And for some of the good ones, they're actually able to maintain a good amount of headroom from this 50%. Now, but of course, not all the Singapore REITs, they are equally resilient. Not all of them are equally good. You can see that some of them are actually at riskier positions where they have their gearing ratio very near towards the 50% mark. Like for example, this one over here, what else? Some of them have very high levels, okay, and the very famous example, where is it? Manulife US REIT. Right? This is another example. So there are some of them which have which are doing better, and there are some which are at riskier positions, right, in terms of their leverage. So we got to be very careful, and that's why it's very important to pick the Singapore REITs to invest in, right? So not all of them are equally good. Not all of them are equally resilient. So we want to pick the good ones to invest in based on their financial stability and the financial performance of these REITs. But of course, the good thing about REITs is that although the share prices are right now declining, but you are still paid dividends every quarterly or every half yearly. So these dividends, they can be used right now to partially cover for the capital losses from the declining share prices. But over the long term, as the share price recovers, you will then be able to enjoy from both the dividends and also the capital appreciation part. And that's how you can actually make more profits from this Singapore REITs, right? So that's what I have prepared for you guys tonight. If you wish to take a further step to learn more on how you can actually build your own Singapore REITs portfolio to earn passive income, you may join us on our upcoming workshop that is happening on 3rd September. Okay, the 2nd July one is full already. The next session will be on 3rd September. So in the workshop, we will share with you how you can actually cherry pick the Singapore REITs to invest in, how to actually buy them at reasonable prices, because many of these REITs, they go through very cyclical price movements. Alternatively, if you wish to learn more on stock chart analysis, right, how do I identify appropriate price levels to buy and sell? Like the ones I shared with you earlier on, for example, support levels. How do we actually identify all this? So we'll share with you a range of technical indicators, all right? And we'll spend more time to go through the basics of analyzing the stock charts so that you can buy at better prices instead of just randomly buying as and when you feel like it, or just chasing after all the all-time highs stocks. All right, so this is to help you make more informed decisions in the stock markets so that you can maximize your profits for your investment. Both of these workshops will be conducted on a face-to-face setting instead of Zoom, so that learning is more conducive. So if you're keen to learn more, you can actually sign up, scan this QR code over here to sign up, or you can go to this website directly, thejoyfulinvestors.com/workshops. All right. And if you're already investing in the stock market for some time, today you are actually keen to explore another financial instrument, you can also find out more about options in our Options 101 workshop for investors, where we'll cover with you the basics of options. What are options? How do they actually work from the point of view of a buyer and a seller? And how would my profit and loss actually change under various scenarios for a call option, for a put option, as a buyer and as a seller, right? So you can scan the same QR code over here or head to the same link for the to find out more about the workshop and sign up for it, right? So that's the end of tonight's market update. If you find this Zoom sharing helpful, do join us in the future sessions. Okay, typically we'll hold it every month, right? Once every month. And you can actually subscribe to our Telegram channel so that you will be notified of the future sessions, right? So you can find us on Telegram, just do a search, The Joyful Investors, and should be able to find us as the first result, right?